Hello my fellow investors and welcome back to another stock analysis video. Today guys, we're going to be doing a company that was recommended by, well, I'm actually not even going to try to pronounce her name because, well, it's in Cyrillic and I don't know how to pronounce anything in Cyrillic, but, well, you know who you are. And you pretty much just asked me to do a couple of Ukrainian agricultural companies, which is actually kind of unique and surprising. It'll be interesting. Now, you gave me 3, and you also followed up with a couple of corrections when it came to the ticker symbol from Seeking Alpha. You gave me MHPSY, KRNLF, and ASTAF. Now, unfortunately, I looked up KRNLF and ASTAF, and those do not come up on Seeking Alpha, but the one that does is MHPSY. So we're going to be analyzing this company, guys. As you can see, this is the website. I have no idea what this says. I don't speak Cyrillic, but I am able to still analyze numbers. So with that said, let's get started with analyzing this company. We're going to start off with jumping into the calculator, guys. This company does not pay out a dividend. Now, ticker symbol of MHPSY, market cap of $415.31 million. And yes, guys, this is in US dollars. If we come over here to Seeking Alpha, we can see that this pretty much says ping current info USD, and also coming here to the financial, scrolling all the way down, in millions of US dollars per share item. So yeah, every single value that you're going to see, it is essentially in US dollars, and again, in accordance to Seeking Alpha. So with a current market cap of $415.3 million, this actually has a PE of 1.22, which is really tiny, like very tiny. This comes out to be, guys, a current share price of $4.33. Now, based off of this PE, it's telling me that this might actually not be too bad of a price. We'll take a look at other fundamentals in just one second, but based off of this, it's telling me that this might actually be a fairly good price to buy this at. Now, they do not pay out a dividend, which means that all of their cash flow is going into themselves. However, if we just take a look at these free cash flows, we can see that as of last year, guys, they were at negative $17 million, which is not good. Let's analyze this further in just one second when we take a look into their fundamentals. Now, starting off, guys, with the net income, we got 5 years ago of $203 million to 1 year ago of $375.5 million. That is an increase of 85%. Now, we do see something interesting here. From 5 to 4 years ago, they actually came down to 125 million. Then they came back up 3 years ago, surpassing even 5 years numbers to 218.4 million. And then 2 years ago, probably because of COVID, honestly, they came down to negative $136.5 million. But after that, they rebounded very nicely to $375.5 million. I'm going to give this, guys, the benefit of the doubt and say it was COVID related. Now, obviously, we know what's been happening with Russia and Ukraine, right? And we're probably going to see something major when it comes to these current numbers over here once we get this year's values. Be prepared to see major negative values. So with that said, keep that in mind when investing into this company because of the fact that Russia invaded Ukraine. And you know, that could be something good in the sense of, like, it might be at a decent value to buy that now if you believe that all of this conflict will go away in the future, right? You buy it now really cheap, but assuming that things really go bad and that, God forbid, Russia annexes more of Ukraine like they did with Crimea, yeah, this might actually be fairly bad, guys. But currently, as it stands, just by looking at these numbers, we can pretty much just see that, well, they are increasing. So aside from this 4 year ago number and this 2 year ago, which I'm going to say it's COVID related, I'm actually going to give this not a bad value because of the fact that it is increasing. I'm going to say at around like 60% or so. Now, looking at the free cash flow, guys, the lifeblood of the company. Now, we did see last year's free cash flow in just a couple of seconds ago when we were analyzing the beginning of the company, and well, you can see that it was negative. Now, unfortunately, we do not want this to happen because cash flow, it is essentially what companies use to pretty much pay out everything, right? Make acquisitions, buy back shares, pay down debt, etc. So we got 5 years ago of $109.6 million to 1 year ago of negative $16.9 million. That is a decrease of 115% with a 5 year average of $105.52 million. Now, if we actually take a look at this graph, guys, we can see something similar to the net income, but as of last year ago, they were in the negatives. Now, we do see another decrease from 5 to 4 years ago, and a massive spike up to $389.7 million 3 years ago. They came down 2 years ago, probably because of COVID, to negative 2.9, but unfortunately, they did not rebound. So that's a little unfortunate to see. They have not rebounded. And again, as of what I just said, seeing that Russia just invaded, things will probably get a lot worse before they get better. So I don't foresee this thing going into the positives anytime soon, but obviously I could be wrong. Now, seeing that we do have two negative numbers and we do have a massive decrease from 5 to 4 years ago, I can't give this a really good grade. Normally I would say, okay, ignore the 2 year ago number, but I cannot ignore this 1 year ago number. So for that reason, guys, I actually have to give this a really, really low score of like 10%. Now looking at the revenue, we got 5 years ago of $1.3 billion to 1 year ago, guys, of $2.4 billion. Increase of 84.21%. Okay, it's actually not too bad. And on top of that, this graph looks actually really good. From 5 years ago to 3 years ago, consistently increasing. They dipped 2 years ago to $1.9 billion, probably because of COVID. So perfectly understandable. I'm going to pretty much ignore it. And then 1 year ago, they made $2.4 billion. Guys, I'm going to give this like a 95%. This is looking really, really solid. Consistent increase, pretty much. Again, ignore 2 years ago because of COVID. And as it stands, from what we see right now, it's looking very, very good. Looking now into the balance sheet numbers of assets minus liabilities, hopefully their assets cover their liabilities, because if they don't, then we do have a really bad problem. Now, this is actually looking fairly interesting because currently they're at $1.6 billion in this difference. Now, looking at this graph further, we can see something similar to that of the revenue. From 5 to 3 years ago, pretty good increase. That is a little bit of a jump that I don't necessarily like from 4 to 3 years ago, but it's okay. I'm gonna just give it the benefit of the doubt, right? And then 3 years ago to 2 years ago, they came down, probably because of COVID, so ignore the 2 year ago value. And then they rebounded 1 year ago, surpassing even 3 years ago by around $1 billion or so. Actually more than $1 billion, by like $2 billion or so. So that's actually fairly good. Now, currently, they're at $1.6 billion, as I said, but they do still have a couple months left for this year to end in order for them to get beyond this $1.8 billion. But then again, I don't necessarily know if this will be the case because of the whole Russia-Ukraine situation that's been currently happening. Average total assets around $3.3 billion. Average liabilities is $2 billion, and doing this difference we get $1.4 billion. I'm actually going to give this, guys, not a perfect score, but it's looking very good. I'm going to say that based on everything that's been happening, they will not be able to reach this $1.8 billion that they did 1 year ago. But they're still fairly close, and they did go up significantly more than that of the 2 year ago value. And seeing the current situation, I think they're still doing fairly good. So I'm going to give it, guys, like an 85% for this grade. Now let's take a look at the cash flow minus liabilities, because just because the assets can cover it doesn't mean that the cash flow can, and cash flow is essentially what companies use to pay down their debt. So very, very important. Now, unfortunately, we see this thing drive itself into the negatives by a massive amount. Now, the single year this thing have even like just gone up just a little bit, and obviously this is due to the fact that, well, their cash flow is just not that good, unfortunately, right? I did give it 10%, so that's kind of understandable because the cash flow is really, really bad, but this is not what you want to see, guys. Essentially, they do not have enough cash flow to subsidize their debt. Take a look at the average cash flow minus the average liabilities. We get around negative $1.75 billion. I'm going to give this guy 0%. It is unfortunate, but you know, this thing is just consistently decreasing into the negatives. It is what it is. Looking now at the most underrated of all the profit metrics, we got the shares outstanding. Guys, this metric, it is, well, very, very important, because if a company issues shares, they're diluting you as the investor. So you do not want this at all. And it's actually kind of funny what's been happening here, because it is an increase, it is a dilution, but it's actually not too bad. We got 5 years ago of 106.8 million shares to today of 107 million shares. That is an increase in the 5 year of almost 1/5%. And well, from the previous to the current year, they haven't increased it at all. And what's funny here is that from 5 years ago to 4 years ago, they increased it to 107 million, and then they just kept it the same up until today. Even today, they still haven't increased it. So if this continues, it's essentially the 5 year would be zero, which is, you know, not good, not bad. It's zero, not dilution, but not buying back shares. I still consider that a win for us, the investors. Now, unfortunately, this is a little bit of an increase, so I can't give it a 100%, but I'm going to give it, guys, like a 95%. That's actually really, really good. And now, lastly, when it comes to the cash and equivalents, they currently hold $307.7 million with an average of $246.43 million. Now let's actually take a look at this company's fundamentals really quick. Net income 60%, free cash flow 10%, revenue 95%, assets minus liabilities 85%, Castleman minus liabilities 0%, and the shares outstanding at 95%. Total grade, guys, of 56%. The biggest issue that this company has, guys, is that cash flow. If they were to fix that cash flow, this cash flow minus liabilities would not be 0, and this cash flow would not be 10%. It would be a whole lot higher. I don't think it would reach, 70% just yet, unless they do like a banger of a job within the next couple years. But I think it will get close to like, 30%, 40%, 50%, and this will actually bring the total grade to like around like high 60s, if not right there on the 70%. But as it currently stands, it is a 56% company for me. Now, with that said, guys, let's actually see if at the current share price of $4.33, we would actually like to buy this company. Now, this PE did tell me that it was a very, very good value to buy it at. So let's use revenue growth, predicted share buyback, and the required rate of return to see what kind of price we would like to pay for this company. And just as a basis, we're already at $7.48. Now, adjusting for debt, we go a little bit further into the negatives, but I think this is because of the fact that they do have a lot more net debt than they do cash on hand. So for this video, guys, we're just going to focus on the target share prices, not adjusting for debt. So coming over here, guys, to Seeking Alpha Growth tab, we can see that the forward is 6.17% and the year over year is 29.4. I do not believe this 29.4 at all. I think the real value is closer to the 6. So for that reason, guys, let's say that for the low assumption, let's go to like 3%. For the median, let's go to 4%, and for the highest one, let's go to 5%. Let's still aim a little bit lower for the high one, just in case something really bad were to happen, like, I don't know, an invasion of Ukraine by Russians. So yeah, that's just pretty much what I'm saying there with putting in the 5%. Now for the projected share buyback, well, they haven't been buying back or issuing shares. Well, not within the past couple years, but within the 5 year, they issued around 0.2%. So let's actually say pretty much the same. Let's actually say at around 0.02%, which we're going to make it a negative because it is issuing shares. For the median, let's put it at 0. And then for the high one, let's put it at like 0.1% of shares buyback. Now with that, we do get some target share prices, guys. Not adjusting for debt of $8.30 for the low assumption. For the median, it is $8.61. And for the high one, it is $8.92. Again, I'm essentially going to ignore these because it's just the fact that they have more debt than cash. It is what it is. So pretty much just ignore these. I'm going to focus on these. And well, with the current share price of $4.33, this is looking like a not bad of an investment, guys. Honestly, I would not consider this as like a buy and hold for like several decades, but just from this is pretty much just telling me that this should be worth at around $8.30 at the lowest and $8.92 at the highest. So, do with that information as you will. The current share price is $4.33. You would essentially double your money if you were to believe my highest assumption, and this thing does go to like around $9 at the highest point. So yeah, that's essentially what my assumption is telling me. Again, like I say in every single video, this is not financial advice. Please have these calculators. They are available for free. I have this one, the book value one, the re-evaluation one, and a dividend tracking sheet for companies that pay out dividends. And if you guys just want to track them all, everything is available for free, guys. The link is in the description in this video to a video that has all these spreadsheets. So it really is just my thank you to you for pretty much helping me grow my channel. I really, really do appreciate it. thank you so much for everybody who have subscribed. We're already up to like 1,040 subscribers. That's absolutely insane. So I really do appreciate it. Thank you all so much. If you guys want to see a face reveal, I did make a 1,000 subscriber special video. That's where you guys can see my face there at the very end. So yeah, thank you so much. And again, not financial advice. Please have these calculators, make your own assumptions, because every investment is the present value of all future cash flow. So when it comes to this company, honestly, I do think that they do have a lot of potential, especially if you believe that everything will hopefully end soon with this situation that's happening with Ukraine and Russia. If you think that it will end soon, like within the next couple months or so, or like let's say like a year or two, well, you might be buying this at a really, really good price. But now you're also risking the fact that if things don't get better, yeah, you might end up losing a whole lot of money. So just please be wary when it comes to this. Obviously, your name is in Cyrillic, so you're probably from there. And, you know, you probably know a lot more than me. If that's the case, and you see things on the ground are changing and all this stuff, and you think that this might be a whole lot, like a pretty good price to buy that, well, according to my assumptions, it is. Again, make your own assumptions, but as it stands, yeah, it's looking like not a bad of an investment. But anyways, that pretty much does it for this video. Like to feel like, comment, subscribe. It really does help her with the algorithm on YouTube. You guys can follow me on my music sites, link in the description below. So with that said, peace out, and I will see you all in the next stock analysis video.